5 million people in Britain are earning money, paying taxes, contributing to society, yet they're being systematically denied the chance to own a home. Not because they can't afford it, not because they're financially irresponsible, but because the entire mortgage system was never designed with them in mind. The Financial Conduct Authority has finally admitted what many have suspected for years, that the way we approve mortgages in this country is fundamentally broken. While families struggle to find stability and build wealth through homeownership, an outdated system continues to push them further away from that dream. The implications go far beyond just housing. This affects retirement planning, wealth inequality, and the very fabric of how our economy functions. If you want to stay ahead of the UK's rapidly changing property landscape and understand how these decisions impact your financial future, hit that like button and subscribe to Property Reporter for all the latest updates on property, economy, and housing news that actually matter. The system that's failing millions wasn't always this restrictive. For decades, mortgage lending relied on a combination of common sense, relationship banking, and individual assessment. Loan officers would sit down with applicants, review their circumstances, and make judgments based on a holistic view of their financial situation. But after the financial crisis of 2008, everything changed. Regulators, terrified of another collapse, introduced strict affordability checks that sound reasonable on paper, but have created unforeseen consequences in practice. These rules require lenders to verify income through specific types of documentation, primarily focusing on payslips and tax returns that follow traditional employment patterns. The intention was noble, to prevent people from taking on debts they couldn't handle. The reality has been far more complicated. What emerged was a system that privileges one type of worker over another, not based on their actual ability to pay, but on how easily their income can be categorized and verified within rigid bureaucratic frameworks. The 5 million workers being excluded aren't on the margins of the economy. They're builders, plumbers, electricians, freelance designers, consultants, IT contractors, delivery drivers, and small business owners. These are people who keep the country running, yet when they approach a mortgage lender, they're met with suspicion and bureaucratic hurdles that employed workers never face. A nurse working for the NHS with a guaranteed salary can walk into a bank with 2 months of payslips and secure a mortgage relatively easily. A self-employed electrician earning the same amount annually, sometimes even more, faces an entirely different reality. Lenders demand 2 to 3 years of accounts, tax returns, and additional proof of ongoing contracts. Even then, many institutions apply harsh multipliers or simply refuse applications outright. The self-employed aren't asking for special treatment. They're asking to be judged on the same criteria as everyone else, their ability to make monthly payments. Yet the system treats their income as inherently less reliable, despite many having stable client bases and earnings that have remained consistent for years. What makes this situation particularly frustrating is that these excluded workers often have better financial discipline than their traditionally employed counterpart. So, running your own business or managing freelance income requires careful budgeting, tax planning, and financial foresight. Many self-employed individuals have to maintain cash reserves to smooth out income fluctuations, making them potentially less risky borrowers than someone living paycheck to paycheck in permanent employment. Yet the mortgage system doesn't recognise this. A contractor who has worked continuously for 5 years, earning well above the national average, can be turned away while someone who just secured their first salaried position gets approved. The irony deepens when you consider that job security for traditional employees isn't what it used to be. Redundancies, corporate restructuring, and economic downturns affect everyone. The assumption that employment equals stability while self-employment equals risk is increasingly outdated in today's flexible labour market. But the mortgage industry hasn't caught up with this reality, and millions are paying the price. The FCA's admission didn't come out of nowhere. Pressure has been building for years from advocacy groups, industry insiders, and frustrated applicants who couldn't understand why their solid financial track records meant nothing. What triggered the regulator's acknowledgement was mounting evidence that the mortgage market was actively contributing to wealth inequality. Property ownership has long been the primary way ordinary British families build wealth and secure their financial futures. When you exclude 5 million workers from this wealth-building mechanism, you create a two-tier society where some can accumulate assets and others are locked into perpetual renting. The consequences extend beyond individual families. Areas with high concentrations of self-employed workers see less home ownership, which affects community stability, local investment, and even property values. Landlords benefit from the increased demand for rentals, but tenants face rising rents and no path toward ownership. The system essentially transfers wealth from those who want to buy to those who already own multiple properties. What the FCA finally acknowledged is that this isn't a market failure, it's a regulatory failure, one that their own rules helped create. So what's actually being proposed to fix this mess? The FCA has outlined several potential changes, though critics argue they don't go far enough. One suggestion involves accepting more varied forms of income verification, including bank statements showing consistent deposits, contracts demonstrating ongoing work, and references from accountants. Another proposal would require lenders to explain their rejection decisions more clearly, giving self-employed applicants insight into what went wrong and what they might do differently. There's also discussion about standardising how different lenders assess self-employed income, creating more consistency across the industry. Currently, one bank might approve an application that another rejects, not because of different risk assessments, but because of different interpretation of the same rules. Some advocates are pushing for even bolder changes, arguing that if someone has been paying rent reliably for years at a rate higher than a potential mortgage payment, that should count as proof of affordability. After all, if you can pay £1,500 in rent every month, you can certainly handle a mortgage payment of £1,200. But the current system doesn't see it that way, treating rent payment history as largely irrelevant to mortgage approval. The timeline for implementing these changes remains frustratingly vague. The FCA has committed to reviewing the mortgage market conduct rules, but regulatory reform moves slowly. Consultations need to happen, feedback must be gathered, and any changes require careful drafting to avoid unintended consequences. Industry insiders suggest meaningful reforms might not take effect until late 2025 or even 2026. For the millions currently locked out, that feels like an eternity. Every month they wait is another month paying rent instead of building equity. Another month watching property prices potentially rise further out of reach. Another month of wealth transfer from renters to landlords. The slow pace of reform also raises questions about political will. While politicians occasionally mention housing affordability, the specific challenges facing self-employed mortgage applicants rarely make headlines. Without sustained pressure, there's a risk that initial acknowledgement fades into inaction, that the FCA's admission becomes just another report gathering dust while the underlying problems persist. Meanwhile, some creative solutions have emerged from outside the traditional banking system. Specialist lenders have entered the market, offering mortgages specifically designed for self-employed borrowers. These institutions use different underwriting criteria, looking at bank statements and business performance rather than just tax returns. The catch is that these mortgages often come with higher interest rates, reflecting what lenders claim is increased risk, though critics argue it's more about exploiting a captive market. Mortgage brokers who specialise in self-employed cases have also become increasingly important, knowing which lenders are more flexible and how to present applications in the most favourable light. Some self-employed workers have resorted to more extreme measures, taking on employed positions temporarily just to qualify for a mortgage, then returning to self-employment once the loan is secured. Others have brought on partners or family members with traditional employment as co-applicants, even if those individuals won't actually be contributing to the mortgage payments. These workarounds highlight just how desperate the situation has become, forcing people to game a system that should simply assess their ability to pay. The broader economic implications of locking 5 million workers out of home ownership deserve serious attention. Consumer spending takes a hit when people feel financially insecure and unable to build wealth. The mental health costs of perpetual housing instability are well documented. children growing up in rental properties move more frequently, disrupting education and social development. The knock-on effects touch everything from pension adequacy to regional economic development. When self-employed workers can't buy homes, they're also less likely to invest in property improvements, start families, or put down roots in communities. The economy loses the stability and consumption that comes with home ownership. Retirement planning becomes nearly impossible when you're paying rent on a fixed pension, whereas homeowners can downsize or use equity release schemes. The mortgage lending crisis for the self-employed isn't just a housing issue, it's an economic issue with tentacles reaching into multiple aspects of national well-being. Yet policy responses remain fragmented and inadequate, treating symptoms rather than addressing the fundamental mismatch between modern working patterns and outdated lending criteria. What happens next depends largely on continued pressure and public awareness. The FCA's admission is significant, but admitting a problem and solving it are two very different things. Banks have little incentive to change their processes voluntarily, as the current system insulates them from perceived risk, even if that perception doesn't match reality. Political intervention might be necessary, potentially requiring lenders to demonstrate they're not discriminating against self-employed applicants or mandating more flexible income verification methods. Consumer advocacy groups are calling for a borrower's right to appeal, allowing rejected applicants to have their cases reviewed by an independent body rather than simply accepting the bank's decision. There's also growing interest in how other countries handle this issue, with some European nations having far more accommodating mortgage systems for non-traditional workers. Learning from international best practices could accelerate reform and provide tested models rather than reinventing the wheel. The human cost behind these statistics tells the real story. Teachers who took on private tutoring to supplement their income find themselves disqualified from mortgages despite earning more than they did in full-time employment. Tradespeople who built successful businesses over decades are told their income isn't reliable enough, even as they've supported families and paid taxes without interruption. Young professionals in the gig economy, who've never known traditional employment, face a future of permanent renting through no fault of their own. Couples delay starting families because they can't secure the stable housing that home ownership provides. The dream of building something for the next generation, of passing on property to children, remains out of reach. These aren't tales of financial irresponsibility or people trying to borrow beyond their means. These are stories of a system that has failed to evolve with the economy it's supposed to serve. Each rejected application represents not just a transaction denied, but a life plan disrupted, a future put on hold, a contribution to society that goes unrecognised by the institutions that should be supporting economic participation. As property prices continue their relentless climb in many parts of the UK, the urgency only intensifies. What might have been affordable 5 years ago has slipped out of reach for many, and further delays in reform will only deepen the divide. The longer the system remains broken, the harder it becomes for excluded workers to catch up. Rising prices don't wait for regulatory reform. Interest rate fluctuations add another layer of complexity, with self-employed applicants often facing stricter stress tests that assume they're less able to weather financial changes. The combination of access barriers and affordability pressures creates a perfect storm, particularly for younger self-employed workers trying to get on the property ladder for the first time. First-time buyers already face enormous challenges, but adding self-employment to the mix makes a difficult situation nearly impossible. Parental help, once a boost, has become almost essential, creating another dimension of inequality where those with family wealth can overcome systemic barriers while others cannot. The Financial Conduct Authority's acknowledgement that 5 million workers are effectively locked out of the mortgage system should be a wake-up call. This isn't a niche issue affecting a small minority, it's a major structural problem undermining economic fairness and opportunity. The self-employed aren't asking for handouts or special treatment, just the chance to be assessed fairly on their actual financial circumstances. As Britain's workforce becomes increasingly flexible, with more people choosing or being pushed into non-traditional employment arrangements, the disconnect between mortgage lending criteria and economic reality will only grow. The question isn't whether the system needs reform, the FCA has already admitted it does. The question is whether that reform will come quickly enough and go far enough to make a real difference. For 5 million workers currently on the outside looking in, watching friends and colleagues build wealth through home ownership while they pay someone else's mortgage through rent, the wait for change feels unbearably long. The mortgage system was supposed to help people achieve the security and prosperity of home ownership. Instead, it has become a barrier that reinforces inequality and punishes those whose careers don't fit an outdated template. Until meaningful reform arrives, millions will continue to contribute to the economy while being denied one of its most fundamental wealth-building tools. A situation that benefits no one except those already at the top of the property ladder.